Hi everyone, this is Noah Warsaw from the floor of CBOE. I'm with Group 1 Trading and I'm filling in for Jamie Tyrrell today on the Volatility Sonar. For the 26th consecutive trading day, we've seen the market fail to make a 1% correction. So what does that mean for realized and implied volatility? Well, the VIX is up slightly today, but the reality is that historical vol is continuing to trend lower. And because of that, we're seeing a flattened skew structure occurring across all terms. About 4 months ago, when vol was a little bit higher, you saw the back month volatility bid up a little bit, but now people are starting to come in and sell those back months simply because volatility is not performing month after month. One deviation from that, though, is in the financials. If you take a look at ticker symbol XLF, the skew structure is actually much more profound than it is in the broad-based indices. Front month volatility in XLF is trading for a little under 20, whereas in Jan of 2012 it's trading for about 28. So that represents a 40% difference between the front and the last month. That's significant when you compare it with something like the Russell 2000, where it's only a 15 or 20% difference between the front month and Jan of 2012. And I think a large reason for that, of course, is there's much impending financial legislation to take place that could certainly influence the values of these financial companies and broker-dealers. One very interesting trade we're seeing today is actually taking place in ticker symbol CYB, which is the Wisdom Tree Dreyfus yuan to dollar ETF. Now, as most of you know, the yuan is currently pegged to the dollar, and the Chinese government does not allow the currency to appreciate despite demand conditions. However, there's much speculation across the marketplace today that next month there could be a revaluation of the currency for the first time since 2008. So although CYB is only up 1 penny today, we actually saw 2,000 buyers on both the July 25 line and the July 26 line. So they're clearly looking to position themselves for an appreciation in the yuan if in fact the government decides to revalue it. Now those 2,000 on each line represent about 20% of the total interest in CYB. So because of that, it makes it a fairly significant trade. CYB, because it's pegged to the dollar, is very low volatility. So these options are relatively inexpensive relative to another 25 handle stock or ETF. Volatility in CYB has been about 6 for the past month. So going forward, these investors clearly feel that the yuan has a chance to appreciate against the dollar, and that's why they're coming for those options. Overall, though, it's a very low volume day here at the ETF Super Pit at CBOE. We have products on over 200 different names here, but those are just a couple of the names that are seeing some activity. Overall, the theme of the week continues to be positioning oneself for the short trading week and looking into 2 weeks from expiration now, trying to see where the value of these April options really lie. The XLF front month straddle is trading for 60 cents, and as we get back to the Jan 2012 XLF straddle, it's trading for $4.60. Is it a buy or is it a sell? Nobody really knows, but the reality is that the skew structure difference between those 2 months is quite profound, much more profound than many of the other products we trade here. That's a wrap for me. Good luck on all your positions and have a great week.